Everyone I know has been waiting for Julius's presentation. Julius, I know you got a lot of stuff going on with RRG. What do you have for everybody today?
I want to do a quick recap on benchmarks on RRGs, because relative rotation graphs consist of two major areas, items. One is the universe. It's the group of stocks that we want to look at. And by the way, RRGs, they show trends in relative strength or trends in performance of multiple securities in a universe against a benchmark and against each other. A quick reminder, I'm sure you've all seen this before, but I keep running into people who say that it is showing performance, and that is not the case. It's not the case. It's not showing you performance as such. It's showing you trends in relative performance, and especially in markets that we see right now with, one day going up, one day going down, we can have situations. Staple sector is probably the best example. On the RRG, especially on the weekly, it's still very weak. It's in the lagging quadrant, but as Tom has pointed out earlier, it's a safe haven. On weekdays, people flock to the staple sector, and then you see positive performance in the staple sector for 1, maybe 2 days. But it's still in the lagging quadrant on the weekly RRG, and that's because the weekly RRG looks at the weekly trend. So please bear in mind that it showed that we're looking at relative trends, not a relative performance per se. What I want to talk to you about today is as I said, benchmarks, because we can play games with benchmarks, and they can significantly change the way an RRG looks. Combined with that, I want to do a quick word on open and closed universes. I pinpoint $1 as a special benchmark. And I want to talk a little bit about asset allocation, using RRGs for asset allocation. I write about it on a regular basis. I've just written about it for the Chart Watchers newsletter. And we're going to show you that we now have a pre-populated group in the drop-down of the RRG chart on the site, so you don't have to do it yourselves. Let's just start off with the asset allocation stuff that I'm working on. What I use here is a group of ticker symbols that all represent a specific area of the market. We got real estate, V&Q. We got LQD, which is corporate bonds. We got IEF, which is government bonds. We got HYG, which is high yield. SPY, obviously the US stock market. DGP, which is commodities, and then I've added $USD to my universe, which is the US dollar index. And I primarily did that because I started basically rereading or reworking my way through John Murphy's latest book, Trading with Intermarket Analysis. And what the project that I'm on is trying to get all the relationships and the intermarket relationship that he is talking about and is describing on an RRG, or use RRG to support those intermarket relationships. And this asset allocation RRG is the first result of that, so to say. While we're at it, I can show you that in the drop-down box, you see that the asset allocation group is now there, so you don't have to type in all these symbols yourself and save it as a permalink. You can just go to the groups and click asset allocation, and the RRG will be populated by the various asset classes that we have there. Now, before we dive into the analysis of this chart, I'd like to play with benchmarks a little bit more. If we move to the US sector RRG that we're looking at right here, you see we're all familiar with these 10 are now with real estate ETFs that track US sectors, and we're using SPY as a benchmark. Now, this is what we call a closed universe. And that's the reason for that is that all these sectors together make up SPY as an index. So everything on the plot is included in the index. That makes it a closed universe. Closed universes typically show a nicely scattered, evenly spread out RRG with a decent spread around the plot of all the various items on the chart. If we go back to the asset allocation RRG, it's an open universe because VBINX is the Vanguard Balanced Index Fund. that consists of 60% US equities and 40% US government bonds. So basically, the only two items on this chart that are included in the benchmark are SPY and IEF. So if I would basically do this, limit my chart to SPY and ETF, this is a closed universe. So here, so by the way, it's a great chart. You just use these two ETFs and VBINX to answer the question whether you want to be invested in stocks or in bonds. And you can actually play the rotation over time of the relationship between stocks and bonds. And you can see that, for a very long time already, equities are, moving on the right-hand side of the chart and bonds are on the left-hand side of the chart. That's still the case. We'll go into a little bit more detail later. The fact that we are adding other asset classes, other ticker symbols to this group and compare them to VBINX means that we are stepping outside of our benchmark. So, for example, commodities or corporate bonds or high yield bonds or real estate are not included in the benchmark. But if we are running a portfolio, we can use those asset classes to beat our benchmark instead of just using equities and bonds, and putting them on an RRG and comparing them to that benchmark will help you pinpoint potential pockets of alpha that are not available inside the benchmark. Now, the other thing with a open universe, I can best show by, again, we have, you probably have seen that, added all the members of the various sectors to the drop-down menu. So if you click on the S&P 500 sector ETFs, you get the ETFs themselves, so the sectors. Now, let's say that we want to look at XLP. It's interesting. It's an interesting sector. A lot going on there. It's been a dog for a very long time. And the fun thing is that I was yesterday, I spent pretty much all day at Robeco Asset Management in Rotterdam in the Netherlands. That's the biggest asset manager in the Netherlands. And I did 2 workshops for their portfolio managers, 3 hours each in the morning, 3 hours in the afternoon. And these guys are, super relatively orientated. They need to know what's outperforming. And it was a guy. One of the guys was the fund manager of Staples fund, or consumer fund, they call it, the consumer fund. So, consumer staples, consumer discretionary, that relationship was very important for him. And I was talking to him and I said, can you, because Staples has been so bad. I mean, I can imagine that you just don't want to be invested in Staples at all. What is your possibility to do something about it? Guess what? His allowance, he was allowed a maximum of 10% cash in his fund. So this guy is running probably a couple of $100 million US in a consumer fund. And he knows that the staple sector is going down, but still he needs to invest 90% of his fund into that sector. So what is he looking for? He wants to look at the best stocks in that sector. And we played around with RRGs. And what we do here is we then bring up the staples sector against the staples index, so XLP, and then we look for stuff that's outperforming the benchmark, in this case, the sector benchmark, XLP. And Tom, I just heard you talk about Kroger, and immediately home, this was the stock that we brought up this exact chart yesterday when I was talking to him. And one of the stocks that I said, this one really you need to have in your portfolio because it looks really good, was Kroger. And that was yesterday, my time afternoon. So look at what happened here.
Hey, Julius, would you buy a stock heading into its earnings? I mean, if you saw it yesterday and you knew they were going to be reporting earnings today.
I know your point about it, and I'm probably with you from a retail point of view. But this guy has no, that's not an issue for him, because if he buys something, he needs like 1 or 2 weeks to build his position to begin with. So buying into earnings or something like that, that's not something that these guys are worried about. Would I buy it from a trading perspective? Probably not. I don't know. I'm not so much of a trader. So yeah, it's a difficult question for me. but you're much more of a trader, much more of a swing trader, and I know you stand by your rule that you don't buy into earnings. And I've seen enough of your examples where it was a very good rule to not buy into earnings, but I thought this one was too good to pass on as an example of how you pick stocks, good stocks, in a sector that's underperforming like nowhere.
Yeah, well, I think, as far as that earnings comment, and I'll just make a quick comment and
no worries.
We had Grayson Rose on here yesterday, and he was talking about having a trading system and just sticking to it, knowing who you are and what kind of trader you are, and then sticking to your rules. And so when I think about earnings, for me, it really comes down to what kind of trader you are. Obviously, if you're a long-term investor, you can't be worrying about earnings because they come out 4 times a year. And so, it doesn't really fit with a long-term investing strategy not to hold into earnings. But if you're a short-term trader, where you tend to hold for maybe a couple of weeks to a couple of months, then earnings becomes a very big factor that you have to consider, because in the short term, if you're trying to make, say, 8 to 10% on a trade, and all of a sudden you buy a stock, goes into earnings, and you lose 20% the next morning, it takes a lot of positive trades to make up for that. So it's just a risk for me personally that I don't like to take. But again, if you're more of a longer term, as Grayson was talking about yesterday, he likes to see, relative strength, and he likes to ride it. And if you're going to ride that over long periods of time, obviously you're going to hold into earnings.
Yeah, I mean, that's totally true. I mean, everybody's got to do what they feel comfortable with. We got so many different flavors of traders: short-term traders, swing traders, long-term traders, scalping, intraday traders. I mean, high frequency, probably not on the audience right now, but high frequency traders, computer programs, etc. So I really believe that everybody should employ a strategy or apply a strategy that they feel comfortable with, that they know what it's doing, and they can more or less predict what's going on. So that's that. By the way, if you talk about Grayson, if you haven't read his latest blog, Stop Tinkering, I believe is the title, about you can overanalyze, but once you've got something, you stick to it and you start executing it instead of trying to what if. That's a great article. I complimented him on that because I really like what he wrote there. Going back to the benchmark stuff, we here now have again, this is a closed universe because we have all the consumer staple stocks and the consumer staple sector. And we can also put this against SPY. And now it's an open universe. And because then I should put it on weekly. Now we only have a subset of SPY against the benchmark SPY. And we all know that staples as a sector was very, very weak inside lagging. And here you can see that the majority of the stocks inside the staple sector are inside lagging against SPY. So this is how you can play around with open and closed universes and different benchmarks. As long as you know what you're looking at, feel free to use anything, but please be aware of what you're looking at and don't make mistakes with that. Now, there is one, I call it a special benchmark. That's the $1 symbol, because so far and until now, everything that we've done here on RRGs is relative. We have a relative rotation graph, and for example, this one shows you all the sectors relative to the S&P 500. Now, what if your benchmark, and we have the pull up. Let me see what the status is of that pull. Oh, S&P 500, 76% looks at the S&P 500 as a benchmark, and only 11% looks at absolute return. That's interesting. You're looking for an RRG like this. This means that if you, for example, continue to hold XLK or XLY or energy for that matter while it's still in the leading quadrant, and the S&P starts to slow down or go down in price, and these sectors continue to outperform, you might end up in a situation where you are outperforming the S&P 500, but you're still losing money because the sectors that you hold. But the only thing is you lose less than the S&P 500. That's the relative play. If you are interested in absolute returns and you say, I don't want to lose money, I just want to keep my money and look for absolute returns, you may want to consider looking at $1 as the benchmark for your RRG. And what this will do, this will compare all the sectors to one. So this looks at absolute return. It's now either up or down. And the center of the chart is now 0% return. And as you can see, you know, the position of these sectors is still the same. The center of the chart has changed, and the trails have changed a little bit because now it has become a moving target, or basically a double moving target. Because if I add SPY to the canvas, to the groups, then you can see SPY here and the others around it. So if you draw an imaginary crosshair with SPY in the middle, that would represent the position on a normal RRG with SPY as a benchmark. Now, see what happens if we start scrolling through it. So let's go back in time and then max it out here. And let's play a little bit of history. Let's highlight SPY. Here you go. And now we plot through history, and you can see that SPY is obviously moving against $1, and all the sectors are moving against $1, but they're also moving against SPY. So the relative point is against SPY, so that's here, and you got everything against SPY. And in absolute terms, it's now moved against $1. So you can use this actually to get a handle on both the relative and the absolute performance, trends in performance at the same time. Just wanted to update you on this usage of $1 as a special benchmark. One of the other things that I've played around with, and then we'll start looking at the actual markets at some moves that we see in asset allocation or various asset classes. If you I think it's you have to be an extra or a pro user. You can use user-defined indices. And I've been playing around with that. And what I've created is, let me put that in a different chart to start with, is an index, and I call it 5%. And that's a line that grows at a rate of 5% per year. This one always goes up. So if you say, I'm not only interested in absolute return, but I want to make 5% per annum on my money, then 5% per annum is your benchmark. It could be. I mean, it could be an absolute return, and you want to make 5% or more per annum. Now, if I stick that at 5% in an RRG, then all of a sudden, everything is compared to 5% annual return, and I get an RRG. And this one continues to move up, and I can see which sectors are giving me that return. And you see that now everything is shifted to the right because the stock market in general has been doing very well. You know, most of the sectors have been beating that 5%. XLE, XLF, not very recently. This is XLY. Look at this. It's a daily. So if we move to a weekly, we got a little bit longer term picture, and then we'll have XLP showing up. Improvement, safe haven over the last couple of weeks. You see that coming up. So this is how you can play around with benchmarks and with groups, talking about open and closed universes, talking about different benchmarks, and you will now have available the various drop-downs, pre-populated groups. Let's go back to asset allocation, which was the stuff that I recently wrote about, and it's always an interesting subject because if markets are moving around like they're doing right now, upswings, downswings, volatility increasing, I think it's always good to step back and see, take a big picture view and find out what's going on. And on the weekly, so the longer term trends, it's pretty clear that SPY, so equities, is doing well, and IEF or government bonds are doing not so well. So based on this relationship, on the weekly RRG, on the weekly charts, you got to prefer equities over bonds still. Now, at the beginning of the week, we had a few moves that, threw some curveballs at the market. And when I look at the daily version of this chart, you see some things that have started turning around. And that's not so nice, because what you see here is that, the improvement of SPY, as you can see here, the green one moving into the leading, has rapidly turned around and started moving into weakening, and heading in a negative area. And IEF, and I'm gonna take out US dollar because it, oops, sorry, SPY, take out US dollar because it's, come on. Well, there you go, go away. Here is EIF, now you can see it more clearly. IEF has started to move up very clearly now. So based on the daily, we now see the shift out of equities into bonds. Now the big question is this the beginning of a new and larger move, or is this one of these quick rotations as we've seen them so often over the past 2 years already, I have to say? Answer is, I am not sure. I'm going to watch this relationship very, very closely. And if we look at the, let's take the two charts of SPY and IEF. IEF. I need to learn this better. Asset allocation, here you go. IEF. Yes, so what we see here is IEF. This is a chart that I've been playing around with for a long time. We had this weakness at the end of last year, a little rally, and we're now testing that 100 support level. This, to me, looks like selling pressure still. So if we break that support level, then this relative trend is gonna, continue downward, and IEF is gonna underperform equities. Equities are going to go up. However, we are setting up something that could become like a double bottom at this support area. And then we have quite a bit of upside in terms of bonds. We've got quite a bit of upside going to probably 105. Question is, what do we do now? I'm holding my horses. I'm still overweight equities. I like equities. The longer term picture looks good, but I'm on the edge because I don't like what I'm seeing here. I need to see this break below 100 to give equities that boost that they need. And if we look at the chart of SPY, which you probably can all dream, we had this very nice big triangle that we broke out of, which is good. That uptrend is there, is still good. But we've got this 278 level that's becoming quite a bit of resistance. So we really would like to see SPY going above 278, 280 probably to be sure, and continue its way up, or things will change there as well. And the one thing that worries me a little bit is the fact that relative strength broke out of its channel somewhere in March, April, in the red shaded area. The RS ratio was at extreme level, so it wasn't a big surprise that it was coming down. The uptrend is still there, but if we take this trend channel as as the trend channel in relative strength, then we had a breakdown. The old support is acting as resistance already a few times. Can we break these previous highs? We need to break those previous highs to continue that relative uptrend. It looks pretty good for now, but if it can hold, I don't know. So for the time being, still overweight equities over bonds, but very, very careful and very, very cautious to monitor the short-term situation, whether something is going the other way around. Do I have 5 more minutes, Tom?
Yeah. Can I ask you one question though about that while you're talking about the relative?
Of course. Yeah.
Because you show that breakdown of that channel versus the VB.
VBINX.
Yeah. Show that breakdown in March, and that was just about the time the dollar started to sprint higher, and we've seen a lot of relative outperformance in small caps. So I guess, you know, when you're looking at this and you're saying you're drawing the conclusion about equities and whether or not, you know, whether, you know, you want to be in equities, do you break down the large cap S&P versus, say, the smaller cap Russell 2000 to see how they're performing? Because it could just be reallocated.
You are such a great host. I have not looked at it, but we can do that because here we have size segments. I think I've broken them down a few. So this one looks at large cap, mid cap, small cap, and I use the Dow Jones sector family, index family to do this. So here you go. This is your small cap. Small cap super strong, and you don't want to be in large cap, and so small cap is the place to be. That's very clear. There's that. This is, you know, here's your small cap. Sorry, here's your small caps. The center is the Dow Jones US index, and here is mid cap, and here is large cap. And we can actually, I have another one that I've set up, and that's, I call it all in one, because you can also split these sector indices in value and growth. So if we look here, fit. Let's see. This is US growth large caps. So in large cap, you're still large cap growth stocks. That's super strong. And then it's growth, and you got small cap growth following suit. And small cap, that's the whole small cap. So this is growth and value together. Now let's see where value is. Small cap value. Okay-ish, not fantastic. And in the lagging quadrant, we got value. You know, so if you want to make a breakdown, growth versus value, it's very, very clear that you want to be in growth still and not in value. You know, that's a very clear message here.
Yep, and with small cap growth kind of being the leader there.
Exactly, yeah. So large cap growth still outperforming, but it's trailed by small cap. But that's probably because we've had such a strong run in the S&P 500 in the large cap stocks. But small cap is very rapidly picking up. So yes, you are absolutely right. Small cap is a very interesting area of the market right now.
Awesome. Another great discussion, Julius. Always a pleasure having you on here going over the RRG charts. I think it gives our audience another opportunity to see these RRG charts, how you use them, and to better their own trading based on that. So always appreciate you coming on here.
No problem.